there's a reliable and consistent way to scale this business and to make this thing a profitable venture for you. And there's just a couple levers you need to pull to do that. And I think people just need to live in that reality.
Welcome, everybody, to another episode of The Big Picture Blueprint. Mason McDonald and Dan Haberkost here, where we got to interview a buddy of mine that has a huge operation doing what we do, spread out all across the country, and had just a ton of fun getting to chat and look under the hood at how he makes it happen. But before we get into it, Dan, how are you doing?
I'm good, Mason. It's always fun talking to other practitioners. And who we have today is Clay Hepler. So Clay's built his business, Hepler Land Holdings, into the seven figures, and they buy, sell, and develop rural recreational tracts all over the country. He's also the creator of the Landman Accelerator and hosts the Landman Show, where he breaks down the systems, sales processes behind a scalable land business. And so that's really all this show is. This is breaking down from acquisitions, data, sales negotiating to disposition, the whole kind of sequence of events that leads to a profitable land deal one by one, and what he's doing today. So let's bring him in.
Clay Hepler, it's great to have you on the show. How are you doing?
I'm doing really well, man. I'm looking at your polo, and I've been meaning to make like a remark on it. It looks really very sharp looking polo. For those who are on YouTube, I mean, he's looking good, Well,
dude, this is why advertising works. I got 5 million ads. This is Amazon. PJ, like Paul Jones or something like that. It's
okay.
$30 on Amazon. So they've got it done. I have yet to wash it. But we'll see if it survives longer than a day. But thank you. My ego just keeps inflating and growing larger and larger. But
I know in Colorado they don't, they tend to not like, it's kind of natural. They don't like wash their hair with shampoo, but I didn't know that also they don't wash their clothes. That's a new thing for me.
I don't. And Colorado Springs is the worst dressed city in the country. And here I am doing something for it, if not smelling great.
Okay, great. Good enough.
Beautiful. Well, Clay, it's exciting to have you on the show. You're the only other person that I've ever met that has lost money on a land deal before, at least that will publicly said it. But before we dive into some of the fun stories and horror stories, can you give the listeners background about who you are, where you came from, and where you're at now?
What a way to start a podcast. Guys, he has no credibility. He's lost money on land deals. Like, I don't know, so I was how far back? Like, just getting in the real estate business, I'll just go there, right? Because we'll start from the top. Basically, was in the rental property business, buying rental properties out here in the Midwest. And they're fine in Colorado when they're, built after, single pane windows, sandstone foundations, right? And just the worst type of plaster and lath, and all the worst things that you don't want to buy in a rental property. Bought a lot of them very quickly. And wasn't the greatest manager, and picked some bad property management companies and started to not cash flow. And, at that time when I started to not cash flow, by the way, had been house flipping, doing house flips, buying self-storage for a local mom and pop, real estate guy, owned a couple hundred units, pretty successful guy, was working with him, and I started buying my own buildings. And shortly thereafter, I realized I wasn't the greatest manager of these types of buildings because they're really difficult to manage, CapEx, general management. My wife was, at that point, she had a job and she was doing quite well. And then the day before Thanksgiving, a couple of years ago, she got a call. Her company went under. VC funding didn't come through. And so I was stuck with the stark reality of, hey, we have to make money. And just like any, ambitious millennial, I went to the internet and found some opportunities to make money. Everything from e-commerce to quick ways to make money, right? And what life insurance. I mean, literally anything, because at that point I was just desperate. I said, hey, I have these set of skills, which is marketing and sales, and I can do this very, very well. And so what's the way for me to scale capital quickly, make a lot of money quickly? And it wasn't going back into the corporate force at that point. I was no longer working for the guy that I was working for. I was doing all this stuff on my own, buying these apartment buildings. And I found land investing shortly thereafter, took some guru courses, figured that, you spend some money on guru courses, they would be really helpful. They did give me the context, but not enough. And so I went out there and sent out 15,000 mailers and didn't get a single deal. This was back in the day that happened. Never. But finally got a deal in Santa Rosa County, Florida. And the rest is history.
All right. There's a lot I want to unpack there, but you hit on something that just drives me insane. So I'm so glad you brought this up. I hear people, especially in expensive places like California or Colorado, talk about, I want to go to the Midwest and invest for cash flow. And you're in Pittsburgh. I'm from near Cleveland. The first property I ever bought was in Cleveland. And they don't appreciate the massive headache, expense, and difficulty that comes with all those things you described in these old buildings in crappy areas. I sold the only buy and hold property I've sold was my duplex in Ohio, because it had knob and tube wiring, which was normal there, asbestos tiles, all kinds of just old crap. And that is a much harder business, and your expenses will be so much higher. So often when people run their numbers on these old Midwest properties and think that they're going to get all this cash flow, they're delusional and don't realize the CapEx that comes with it. So I just had to say this. I don't want to make this a rental property discussion, but I just think that isn't often talked about enough. And the difference between, a 2000s build in Colorado somewhere and a 1940s build in Cleveland is just exponentially different management and cost to maintain. So that's my rant on that.
Yeah. It could and make that 1900, not 1940. Give it an extra 40 years. So, yeah.
So, all right, you got into land, and your first big campaign didn't yield anything. So I saw you made a post about this recently, and it was how to fail in land investing. And it sounds like you were maybe just talking from your own experience of that first campaign that didn't work out. So can you break down everything you did wrong that led to you getting, no return on those first 14,000 mailers?
I think I priced them. I remember pricing them. At that point, there wasn't the data that we have today. I sent a bunch of mailers to wetlands. I didn't scrub any mailers whatsoever. And so I mailed this county. And I was like, dude, I was getting so many response rates. It was like a 3-4% response rate. I was like, man, people said that I wouldn't be able to do this, but on my first mailer. And I realized they were all in a subdivision that was wetland. And in Florida, there's a lot of there are a lot of wetlands that are protected wetlands. It's 232 feet is the highest elevation in Florida in general. And so I'm sure you guys have invested in Florida. There are a ton of wetlands. And at that point, I wasn't sophisticated enough to understand, hey, you can mitigate wetlands sometimes it's worth it, sometimes it's not. And so I sent a lot of mailers to the wrong county. Maybe at the wrong time. I honestly don't know. But there are a couple of subdivisions that I was doing super precise pricing. And honestly, I don't really know why I didn't get the yield that I thought I was going to get. It might have been the impulsiveness of getting starting out, having the mentality of just send it, just go, the entrepreneurial zest of right during COVID. I had that, and I was like, I'll just do it and I'll figure it out along the way. So I think I just didn't price them correctly. I hit the wrong markets. It was just a storm of misfortune, and ended up netting me no deals.
Sure. I'm glad you made the distinction of sometimes it's worth mitigating wetlands or buying with wetlands. Sometimes it's not, because I've bought and sold tons of property with flood zone and wetlands. It's just a function of supply and demand and the price of the market often. Now, you got that first deal in Santa Rosa County. Where did you go from there?
Yeah, I mean, after that, I just was like, hey, this is gonna work. I'm committed fully to it. The problem was during that time period, I was unable to just keep my money rolling. I had to take money out of the business. So there were some credit cards that were being racked up, but I was like, hey, I'm in this. I just got to keep going. I don't recommend this, by the way. This is not the way that you should get into land investing. But then it just kept sending mailers. Honestly, that was pre-texting, right before texting. Texting was about to kind of come on the scene, and so we just sent mailers to a bunch of counties in South Carolina. a bunch of counties in North Carolina, and started to get some true deals back. Got this like little nice subdivide that we got, and then started to get more deals. And then my wedding was coming up that summer, and so we had a couple like a decent subdivide, and started to get some small flips, and bought a portfolio of deals, and then bought another like 20-acre parcel that we cut into like 3 6s and just murdered. Just an amazing deal. And so I think there was some luck there. I probably made like 80, 90 on that deal. And so that was like, this is great. And I had enough cash to keep the business going. And then I realized that I needed to bring on some people. And so I hired my first employee, who's still with me today, going into that spring to summer, because I was going to be away for a week and a half for my wedding. We were having our wedding in Spain at that point. So I hired my first 2 employees. One was a lead manager. The other one was a data texting person. Because I was doing everything myself, pricing, pulling, doing the whole pulling from priced, pricing myself, sending the mail, taking the calls. And then I started to kind of scale with the first lead manager and data person.
Awesome. And Clay, we appreciate the background. And I think that, it's cool to see how similar so many of us had like the journey at the beginning of either doing really well or having a few mistakes and then taking off. And then things have gotten a little more complicated with the market, but you're still crushing it. So let's fast forward to today. We're recording this at the end of August of 2025. You and I chat regularly now, and I know you're doing some shifts in your business, but what does your team look like going into 2026? What do you feel like your team is going to be? What the amount of markets that you're doing deals in, the type of deals that you're looking for? Just break it down, and then we'll dive deep into it.
So if I got correctly, it's what does the current team look like? What does 2026 look like? And I can give those kind of the 2 core things.
Yeah. Your process and your operations and your deals, basically.
Cool. Yeah. So currently we have an outbound team. We are calling a lot of cold calling. We have a cold calling team that's a couple of people all over the world. At this point, of the podcast, we have 9 people on the cold calling team. So quite a lot of outbound effort. On the cold calling team, we are sending mail, and we're doing some other outbound stuff. And the intake team looks like 2 lead managers, a pipeline manager. So pipeline manager is essentially farming the existing leads, because we have like almost 15,000 leads. And so they're going back through the leads and resurfacing them, retouching them, looking for different types of development opportunities or new opportunities for us to re-engage. We had 2 acquisition managers. We're probably just going to be able to do 1, because we've been able to be much more efficient, and we're hitting about 35 offers per week. That is like a deceptive number. If I break it down, it's we have a appointment-based offer system, which could be different than a lot of land investors. Some land investors will do a 1-call close. We do not do that. We do a 2-call close. And so you might hear 35 offers, and you hear someone say on a podcast, I do 6 offers a day or 8 offers a day. These are pre-qualified leads that are motivated, that are within 20 to 50% of what we can pay. And so they're very qualified people, right? And so we're at that 30, 35 per week in those types of high quality offers. And I have a director of revenue, which is essentially a director of sales. And then in our marketing department, we have a marketing manager. And then we have a general data person. And then on the fulfillment side of the business, we have a transaction coordinator, a disposition manager, disposition, and I can go into like nationalities and stuff like that if you want me to. Disposition admin associate. So we have that's a big thing that I'm talking about in 2026, but disposition is everything. And so we're building out a robust disposition team so that we can service not only ourselves, but other people. And then I said transaction coordinator. I have a chief of staff. We have a bookkeeper. Let me think. What else? I think that's a lot. I usually miss like one or two people.
Are these all U.S. based, or are they?
They are not. Yeah, they are not. The disposition manager is U.S. based. The director of revenue is U.S. based. Former private equity guy, private equity self storage guy, and the acquisition manager. Both of them, we have two now, but we're probably going to just have one. They're both U.S. based. One of them's like a developer, former developer in he's in South Carolina. I know you have a thing for Southern acquisition managers too, Mason. And yeah, that's the chief of staff is South African.
Got it. So that's a tremendous amount of volume that you're doing outbound. And obviously you have the systems and team to be able to manage it. But in terms of we've briefly alluded to it of like, wetlands in some markets are absolute deal killers. In other markets, it's not a big deal. And when I say markets, I mean at the subdivision level. But every market has its own due diligence criteria, and every state has its own laws and regulations. And there's a lot that goes into operating in all these different markets. So how are you able to manage that at a high level of just like, it feels like it's just like too much volume almost?
Yeah, and we have run into that problem like very transparently. Like you unfortunately, like what we've done internally is we've created like shorter feedback loops, and I could tell you how we've done that. There's like a meeting feedback loop, there's KPI accountability feedback loops, there's like output based feedback loops, and that allows there to be a trickle down effect of like institutional knowledge to trickle down faster, which I think there's a lot of problems for most land investors, that there is there's a constraint of sharing of the institutional knowledge. So like me as a land investor, I can do everything myself, right? And then I bring on people and I expect them to do things as good as me, but I expect them to run the department as well as I do. I expect them to execute as well as I do. I expect them to move as quickly as I am, and I haven't properly given them the feedback loops to do that. Which that's another thing, but I'm going on a tangent here. But that is something that has been problematic for us, right? We have locked up 40 contracts in a month, and multiple times, and a lot of them have fallen through, right? At over 50% have fallen through. It's kind of like, oh, you spend all that money and you have all these contracts that have fallen through. And so I can tell you how we've solved the constraint of that. But you'd like me, okay, I can go in. So I think the core constraint of our business, after you have solved the acquisition constraint, comes down to communications cross department between acquisitions and dispositions, because there is a like market based understanding, and then there's like a universal understanding of what is a good piece of land. But if you don't have a disposition team and acquisition team that can communicate properly together, right? Like Mason, for you, I know that you are kind of both. But when you have multiple people in different roles that you're trying to communicate, that becomes very difficult. And so there's escalation protocols that we have implemented after we've looked back and said, if we've changed like something as simple as what is a qualified lead, right? A qualified lead versus an endorsed lead. An endorsed lead, for example, is a lead that our lead manager, our appointment setter, does not know if the value or the underwriting is fit to be a qualified lead, but they will endorse them to a comper, a specific person. This could be you as the owner of the business. This could be your director of revenue. This could be your acquisition manager. This could be your comper. But we implemented the endorsement to shorten feedback loops between should I just completely disqualify this person, or should I have this so that I escalate it up the chain and so that my team can get better? And then we create loops on a weekly basis to say, here are the exceptions in this market, but here are the exceptions in general. Let me just think about an example of like, it could be as simple as we got a deal for a subdivision that one of our lead manager's like, this could be a really good subdivision because it has plenty of road frontage, but there's like FEMA floodplains and wetlands on this parcel. It's like 150 acres. And if it didn't escalate up the chain, it would have just been immediately killed, but we endorsed it. Our comper was like, I'm not quite sure how to do it. We endorsed it again, right, to the CEO. So you're not like in all the business, or to our director of revenue. And then the director of revenue was like, this property, because the FEMA floodplain is at the front of the property, we could effectively build a road to the back, and there would be the opportunity to actually subdivide this parcel, and it wouldn't disqualify the lead, in other words. So I'm kind of getting really nitty gritty, and I'm happy to keep going. But like those types of tight feedback loops within your organization are important. And it's just like, what's the problem? What's the constraint? We solve it, and then we're like, there's going to be another constraint soon, so we have to solve this now.
No, that all makes sense, and I like the SOP around how you elevate leads from definitely this is a qualified lead, and not sure, and having those second eyes on it definitely helps. Now, you mentioned constraints, and you said acquisitions, and then communication between acquisition and disposition. But the big one in the middle that so many people struggle with is they can get good deals, but they can't find the money to close them. So how are you financing all these?
Well, it depends. Like, I think the evolution of this business is like equity, debt equity, right? So when you're starting out, you rely on a lot of deal funders, and then you're like, hey, I want cheaper costs of capital. And then you go out and try to get debt. And then eventually you go after bigger deals and you bring on LPs. So it just depends on the deal that we're doing. We're doing a deal in Texas. We just got on a contract last week, buy for 600, sell for like 1.1-ish. We're just going to get bank financing on that, and then bring in an LP to be the down payment and co-signer on the loan. And we're going to cut it up and subdivide it. So just on a deal by deal basis, like those types of big deals, we don't want to do cash just because we want to have a better IRR for our investors. But on a general flip, I will self-fund. Sometimes I'll raise equity. Sometimes I'll do debt. It just depends on what's going on in our business. But I've always been like, for better or worse, I've relied on investors to finance my deals, whether through debt or equity, because I believe I can get a higher return on my money investing in my business. And so if I scale the machine through reinvesting in my business, I can get a higher return. I don't know if that answers your question.
It does. I mean, and this evolves over time, right? When you're, like you said, when you're brand new, you need just capital partners. You don't have a reputation, and you can get your cost of capital down over time, and then you scale your deal, and suddenly I see your whole train of thought there. So that makes sense. I do want to ask specifically, you mentioned LPs, so you're actually doing syndications, hiring SEC attorneys, and putting all that together for some of these larger projects?
Like these are all special purpose entities. So when I say LPs, we can just say like co-investors in this special purpose entity. Like we're not like actually syndicating these deals. It's just like too much. I know you guys, Mason was telling me about, you guys had a fund. So I don't really want to have fund pressure, or I don't want to just do like LPG, like SEC attorneys for a $600,000 deal. So usually we'll just do like a special purpose entity, some arrangement like that for a deal, depending on the size, right? Sometimes it's just like a lending agreement that there's like an equity kick, and there's like a minimum, IRR, and then an equity kick, depending on how well it does with some sort of like creative lending arrangement. It just depends on the deal.
Sure. Okay. Fair enough. Now, you mentioned, or Mason brought up, heading into 2026 and what you are and are not changing. Where do you see the biggest opportunities within land that might not be talked about often?
Well, I think Mason is one of the guys that is talking about it. So what we have shared many a conversation around the asymmetry in understanding markets, your individual markets, and like being an expert in your area, I think is the evolution of the business. So like first, you had the farmers that knew what everyone's land was around them, and then many years later, you have the technology and the data, and then now we're going back to like local market intelligence is vitally important. And I think that is the new evolution of the land business. The next iteration of that is, so, you can combat competition through knowledge, you can combat competition through skills. And so this business every year more and more becomes a, how good are you at marketing, direct marketing? How good are you at sales? I just, as more people come into a space, but a lot of people are leaving the space. It's just a skill set thing, right? Markets become more efficient over time. If you're a better salesperson, you will get more deals done. And so I think that those two things, like the skill set of being a good marketer and salesperson, as well as like understanding your core markets, are what is required in order to succeed, whether you're at a larger scale or want to be a one-man show.
Yeah, the understanding your market better than everyone else, that one, I just want to, we talk about that all the time on the show. That makes all the difference and allows your guys to be more confident in speaking to sellers. And if you craft your marketing accordingly, you'll get deals that others won't. So agreed 100% on that.
How have you guys implemented that in your like business? Like, what are some ways that you've, is it just like sticking to the same markets? How do you think about that philosophically?
Yeah, I mean, I think the only thing you can figure out is by being in the market long enough, where you can research it as much as possible, but being able to say, yeah, we've been doing deals here for 5 years now, I think is huge, because you really start learning street by street every single property in the entire market that you're in. And especially whenever your deal size is very focused, there's only a few hundred of them that exist. And it's like, if you've put 150 pieces of marketing material in front of each of those people, you're going to be the one that gets the deal at the end of the day, compared to someone else. And for me, it's locality. I'm local, and I'm doing business in my backyard is really helpful.
Yeah. The other thing I would add to that is just on all of our, not all, but most of our mailers, we'll have X subdivision, and it'll literally have a picture as the background. Here's a lot we just bought in X plantation. We're looking for 3 more this quarter. Or here's 77 acres we bought in X county in South Carolina. We're looking for 3 more tracks this quarter. That has worked really well for us.
Mm-hmm. I like that. That's really smart. Yeah.
So, Clay, we've talked about the dispo part of the business and how that's just so crucial. I mean, the biggest pain in any sort of real estate investing, or flipping more so, is this like cash flow roller coaster that we're always on, of acquisition and then dispo. And if the cash conversion cycle is not what you anticipated, things get really, really stressful and painful. I'm looking at your Land Watch profile. I see how often you guys are posting on Facebook. I know you use local realtors sometimes too, I imagine. What dispo channel has been the most effective? And then from that, who are your buyers right now? Because we've had a lot of success on the owner finance side of things, but there's been a lot less cash buyers the last couple of years compared to how it used to be.
Mm-hmm. This goes back to the market intelligence that we were talking about earlier. That it's like going into an area, and depending on the socioeconomic classes within the area, what is the medium income? $100,000 lot versus a $200,000 lot could be everything. I'll give you a perfect example. You have a property, 84 acres in South Carolina, and we had it listed for like $650, something like that. And our broker, who should have told us this, I want to fire him, but he's like the biggest broker in the county. So like, but he's like, oh, no one's buying properties for like over like 220. That's like the biggest sweet spot. I'm like, why didn't you tell me that like 3 months ago? But we are now subdividing this parcel after the fact, and we're going to bring it to market. And it's going to be 3 tracks that are like $250 a piece, $240 a piece, right? And that opens up the market. And we looked at the sell-through rates of these properties, and they move faster. And so I think that it's like creativity like that matters. and understanding what actually sells well. Someone will be they'll be like, oh, I can subdivide this parcel, right? And I might be able to get a little bit more money if I subdivide this parcel, right? I had a deal. It was 6 acres. We cut it into 3 2 acres. And it's pretty similar county to this other one. And the 3 2 acres were going to go for like 90 to 100, and the 6 acres would go for like 75. And we were buying it for about 40K. And I was like, are you kidding me? I'm going to take the 100K. No, of course. What I didn't realize was that those types of lots were so much slower. It took us a year to sell all of them. Whereas the 75K one, 80K one would have sold, and I look back in the data, it would have sold in like a month, right? And so there is the understanding your market again, understanding what your buyer pool is. And this comes down to talking to brokers. Like we do have, I don't know how many, we have like 25 deals on land.com right now, maybe 20 deals on land.com, something like that. And we have a ton more listed with brokers. Those are mostly self listings or double closings or whatever. And we always ask the broker, like, what's absorption rate for these types of properties in this specific market? We just got a 540 acre tract under contract in Michigan. And it's like a really, really nice parcel. We're thinking about subdividing it, right? But like the question is that better to keep it big for a hunter? Because it's right outside of Detroit. It's right on the lake. Or is it better to cut it into a certain types of properties? Do we build a road out? And people look at purely a dollar for dollar return. Like, so I'm going to get 10,000 acre versus 8,000 acre. And so I'm making that trade, but it's like about the velocity. And so that's why I believe, number one, there's a lot of land investors that are flooding the market with these products that are not for the specific market. But I think it's all understanding those local markets. We do the owner financing. I don't know if this is answering your question, but we do the owner financing and stuff like that to sell our deals faster.
No, it partially did, and we'll come back to it. But I think that was actually one of the most useful pieces of advice we've had on the show in quite a while, because people hear all of these opportunities within the land space, and I think a lot of decision making is ego driven. Of, I want to call themselves a developer to do a minor or exempt subdivision, but it's really, really understanding the product and the market within the product, because you're absolutely right. Of if you can double your money without doing any work, why would you not? As versus like just making 2.1x. And then if you're actually looking at that internal rate of return, like, it starts getting skewed whenever it takes much longer. And I feel like people have gotten into this space thinking that this is the best exit strategy, and they don't even look at the idea of just the simple flip. So I feel like understanding your product, understanding your market, and then one other rant point I want to make is we get people submitting deals to us for funding all the time, and they'll tell us the market value of this property is $1.9 trillion or whatever, and there's never been a property in the entire, call it county as the market we're looking at. In the past 3 years, there hasn't been a single sale over 700,000 for any piece of land, no matter the size. And so if you're telling me that the market value's $2 million, it's not, because there are no buyers for it. Assuming there's enough transaction data to do it. And maybe there's those individual use cases where it's such a unique property or something like that. But then once again, it's a shrinking of a buyer pool. And the more buyers you can bring to the table, the more likely you are going to be to succeed in this space. And whether that's through offering owner financing or through, cutting up into really small, really cheap lots, or because, Colorado is like brings in $2 billion a year from hunting. And I imagine Michigan and a lot of these other states, like the desire is for the hunting property. And you need to take it out of your brain of like, I'm just going to buy the ranch, sell it by the pasture. So, that's my rant. The question that I wanted answered, even though you gave a better answer, was of all those channels, the local realtor, the land.com listings, Facebook, individual dispo teams contacting neighbors, where are you seeing the most success? Like, who's converting the best?
Depends on the product type. right? So below 100,000 Facebook murders, 80K to 100K Facebook murders. Anything above that, it's like it's not going to get sold on Facebook most of the time. It's like, and then I think land.com is, maybe the 50K to like 250, right? Like that's where I see land.com really working if you're self-listing, right? Maybe to like 300. And then brokers, of course, are like the primary channel, right? But like, we have a couple of larger tracks. Like we have this subdivision that, out in Idaho that we're, buying it by the, I don't know what it's called, buy by the pasture, sell it by the farmlet or whatever. But we bought this subdivide. It was, I don't know, like 200 acres or whatever. And we cut it up and everything's above 200K, everything. And we don't put those on Facebook, right? It just, we don't find that there's a buyer. I mean, maybe other people have had success, but I find the buyer pool is 100K, maybe 150. So it just depends on the price, and every price range, I believe, has a better, a certain type of buyer.
Yeah, I don't know. I sold one for 182 on Facebook in July, but that was definitely the most expensive one I've ever sold on Facebook. So that's interesting. I never thought about bracketing it that way. But anyways, so you've talked about quite a few different states. How many different states are you in currently?
A lot. We're trying to consolidate that a little bit, but the one in Idaho was a funding deal. So someone brought it to me to help run it, to help develop it. But I would say at any given time, like probably 15-ish.
Okay, so one thing we haven't dove into deeply here is what marketing methods you're using today. So I know you mentioned cold calling in one of your posts. I think you do mail. What are all your outbound marketing methods as of today?
Yeah, so we use a bunch of different outbound methods. I would say that the core two that we really like is the cold calling method and direct mail. So those are kind of the big two that we get the most bang for the buck for.
Okay, gotcha. And then on the direct mail, let's start with that. All neutral, offer letters, mixable. What does that look like?
Yeah, we are constantly playing with different neutral versus blind versus range. My philosophy is a neutral or a blind offer or range offer. The reason that you give someone a number is to solicit a response, and so provided you have a good enough copy to solicit a similar response for a neutral letter, they're just as effective. So we have done a lot of these different ones, Dan, but at this point, we have stuck a lot with neutral. Like effective this month, we're just staying with neutral, and just focusing on our copy with the neutral letters.
Yeah, I haven't done land offer letters in 3 or almost 4 years, so I'm all neutral too. I agree on that. Now, cold calling. I saw one of your recent posts on Facebook about how cold calling is not dead. It's just that people aren't doing it right. So I think this is true of any legal marketing method. People say mail is dead. It's no, you're just not doing it right. So what do you see that people are doing wrong when it comes to cold calling that's stopping them from getting deals?
There's a lot there. I would say the core problem is, if you're going to commit to a channel, you should commit to getting good at it. And what does that mean? That means every step of the process you should be really good at. Number one, cold call leads take longer to convert. Not 90, 120 days. They convert longer. They're not high intent like a direct mail piece would be. And so there's a longer follow-up process. You need to have a robust follow-up process within your CRM to, work them over time. Also it goes down to like, what dialer are you using? What's your list? Like there's a lot more variables for cold calling. What skip tracing provider are you using? What dialer are you using? What is the type of caller? Are you using global talent? Are they good at what they do? Do you train with them, or you just say, get on a dialer and just start making dials? It becomes more of a people sales-based role. And I think people don't make it out to be that. People just say, hey, just give them a dial and I should give them, a seat and we should be getting this amount of leads per day. But we like have a cold calling manager that talks to our cold calling team members every single day and hypes them up and keeps their morale high. Like it's a psychological game too. So I mean, I think what people get wrong about a core, Dan, is the cold calling is another sales motion within your business. It is not the same as direct mail. It requires a lot more effort and energy in order to get right, versus direct mail is like point and shoot. You have the right, what you're doing creatively, but it's direct or cold calling is a lot more difficult.
So there's so many variables that you just mentioned, which, being a guy that loves statistics and being able to prove the significance of this data, how are you able to pinpoint down which lever to pull on? Is it the dialer? Is it the data? Is it the skip tracer? Is it the caller? And what KPIs are you tracking that whenever they stray away from whatever your benchmark is, proves that point to you, to where you're like, I need to make either a staffing change or a process change or a data change?
Right. I think about it in like you got to get the things right at the beginning of the funnel, then you kind of work your way down. So if you're standing up something like this, you got to get first of all, what's the right data? You got to get the right data. Then it's skip tracing. It's like, what's your hit rate? What's your connection rate? And over time, you just track it and you figure out what's my average connection rate. What's my average skip tracing, like for data to the type of skip tracing, and then connection rate's huge, right? And usually if you solve the problems up the stream, the logs will start flowing down, right? And so if you solve the connection rate problem, like your connection rate, a good connection rate would be like mid 50s to mid 60s. Like that's a very good connection rate on a dialer. If you're at 35, that's bad, right? And so there's probably a data problem there. And so you figure that out first. And then once you have good connection rates, then you just keep going down. Like one of the things that we did, I'll give you a perfect example.
Wait, and time out here. You're saying connection rate as like people that answer the phone when you're dialing?
Yeah.
You're getting over 50%.
Well, the dial that we use is it's like ready mode. And so ready mode is Zen call or whatever. And so connection rate, I believe, it's how the dialer connects with the number, not actually like picking up the phone.
Got it.
That's a contact,
Clay, whatever contact you're doing, like
right. No. That's I think they're a little nuanced. The differences.
Okay, got it. Understood. All right, back to you.
Okay, so I mean, you just keep going down the line, right? So then you figure out that, and then what the big thing that we did is I looked at our data and I was like, what's the most important part of the call? It's the first 5 seconds, right? Because everything else is significantly less important if I can keep this person on the line, right? And so we just look at these like the physics. So we were noticing our drop rate was in the 20s. So drop rate for this dialer is measured by, I think it's like the first 3 seconds or 5 seconds was like 20%, which is like, you could be, oh, it's low. And I was like, that's unacceptable. If we decrease our drop rate to 15, that's a 50% increase of the amount of people that we're talking to. Over like, or no, that's like a 25%. No, that's a 50. That I don't know the math, but it's a significant increase in the amount of people that we're talking to, right? 25% increase. And so that is like statistically incredibly important, right? So if we can increase that means everything down the line is going to be much better. But we said, hey, we're going to increase it to or decrease it to 10%, right? So that is incredibly relevant, right? So we knew that if we could talk to more people, very logically, or more people would talk to us after 5 seconds, we would probably have a higher increase in the amount of leads that we get per day, quality leads. So we went from 0.75 leads per day to 1.752 leads per day just by focusing on the beginning of the script, the first 2 to 3 sentences in the script. And so we didn't have to hire more people. We didn't have to train them better. We just had to focus on the first 3 to 5 seconds of the script.
I love that. And that's something that I've tested a lot, and I'm interested, for everyone that's still listening, thanks mom, that will get this. Clay, what is your opener, when you guys call?
Honestly, I don't know. Like, I can look it up or draw. Like, I don't know. My cold calling manager has all that. I wish I knew what it was. I can try to find it while we're on the podcast.
And you don't need to, but
yeah,
I think it's one of those things where it's like, you need, whenever you're cold calling, if you can get them not to be super defensive, but be curious, within the first few seconds, it's going to be really, really huge. Because, I mean, everyone gets so many scam calls every single day. It's like getting them on the phone and keeping them on the phone is so huge. And that's why, with mailers, it's so important to either do a really good ranged offer, or do a neutral letter, or do a really creative, handwritten mailer or something like that, to get an open rate. Because if no one's looking at it and no one's communicating, then you don't even have the opportunity to use the sales skill that you or your staff have been developing. But in terms of, and we're moving towards, the end of the show, just to be cognizant of everyone's time, but of KPIs within your outbound lead generation team, for the individual person, what do you hold them the most accountable for? Is it contracts? Is it, call time? What KPI do you care about that indicates they're going to be very successful?
Yeah. So just to understand the philosophy, and then I could tell you the KPIs, because like that, the philosophy is just as important as the how to. The philosophy is like every step of our process is like a slice of cake. So like every team member is accountable to their slice of cake. And so, for example, if I were to hold my cold callers accountable to the contracts, that wouldn't make any sense, because like after it's out of their hands, lead manager could screw it up. He could be sick. She could be sick, and we don't get the contract. The acquisition manager could be bad. They don't get the contract. So I think about every step of our process in the conveyor belt is like that slice of cake. And so they have to own their inputs, right? So of course, like the core thing is like, how many leads are you getting per day? And the friction, because we want to pull and a push to our KPIs. So the push is like leads per day per caller, and the pull is percentage of those leads that are qualified. Because we could say, hey, we want 3 leads per day per caller, but 10% of those leads are qualified, versus we're okay with 1.75 leads per day per caller, but you're accountable for them being at least 25 to 30% of those are qualified. And when we say qualified, we mean put them to the acquisition manager. So we have the push and pull for their core KPI, so that they're not just pushing garbage to our team. It just out of, hey, I want to get KPIs.
So with all these different pieces and parts going on, what are you spending the majority of your time on?
When there are problems in the business, I kind of parachute in and serve as a helper, a challenge blocker, challenge removing of challenges. That's a part of my role. We're standing up our dispo department and really doing that right now. And so I'm helping a lot with dispo, so we can scale that nationally. We get a really good dispo arm. I'm spending a lot of time on that. But acquisitions, marketing, like I have a director of revenue that I'm not taking my one-on-ones anymore. I'm not even running the daily meetings anymore. I'm not holding my data team account. Like, I don't look at anything. No marketing, no A/B tests, nothing. The whole front end of the funnel is with him. And then so I'm doing dispo and like managing transactions and investors and stuff like that. And then doing cool stuff like this, talking to my friends on podcasts.
Yeah. Yeah, very cool. But well, the first part's not so cool, having to be the one to deal with all the problems. I get that. When no one else can solve it, they call you, right? But yeah. Anyways, there are 2 questions we always like to ask all our guests towards the end of the show. The first of which is there anything we didn't ask you, any topics or specifics that we should have but didn't?
No, I think that there's a reality, though, that is important, that I see a lot of land investors living in lack today. What I mean by that is they are uncomfortable with having feeling discomfort in their mainland business. and a lament of why, as everyone said, it was so much easier. It's like, hey man, this is a business. Like there are levers that you can pull as a business owner to be successful. And Dan, this as a successful guy. Mason, this as a successful guy. Anyone could do this business. It's really not rocket science. I mean, Mason, you were CEO of a freaking hospital, man, right? Like, it's a very much a marketing and sales based business. And so I think a lot of people are just lamenting the old days. I see posts on Facebook all the time about that. It's like, look, here's the reality. There's a reliable and consistent way to scale this business and to make this thing a profitable venture for you. And there's just a couple of levers you need to pull to do that. And I think people just need to live in that reality.
And I think it's funny on that point, Clay, of we're moving into one of the greatest buying times in recent history, since a lot of us have been in the land game. And if you know what you're doing, it's a great time to be buying land, and other asset classes as well. But Clay, where can people find out more about you?
Everywhere on social media, Clay Hepler, Instagram, Twitter, my website. I'm very active on social media. So.
Heck yeah. Well, man, this was a ton of fun. I feel like we'll have to have you back to get, deeper into other topics as well within the land space. And we didn't even dive on your own personal investing, which I know you invest as well outside of just land. But everyone, this is Mason McDonald and Dan Haberkost with Clay Hepler on the Big Picture Blueprint, signing off.